Good morning. It is Monday, June 2nd, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios 2-1. This is my weekly economic and market commentary. If I have something to say intra-week, we'll put it on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. This presentation has been prepared by Cantor Fitzgerald Investment Advisors. We are an SEC-registered investment advisor. There are no recommendations for purchase or sale of securities. There is no tax advice. There's no investment advice contained herein. All of the views expressed are mine alone, may differ from the views of CFIA's parent affiliates or other portfolio managers of the firm. We'll get into it. We had a pretty good week again last week. You could see the S&P 500 up almost 2% on the week, back into positive ground for the year. Mid and small cap stocks, of course, still negative for the year, but single digits, they were up. International markets continue significant outperformance. We're getting close to halfway through the year. Of course, I was not one that was convinced that this would continue to last, but so far it is. The U.S. is going through some changes associated with international trade, as we all know, and now we've got some congressional bill, the one big beautiful bill coming out. We expect that to get revised by the Senate. Ultimately, most of the provisions, as they stand, we do expect will end up being made into law. Bond market caught a bid last week, even though interest rates had been eking higher. We saw the aggregate bond index up a pretty good amount, almost 1%. Positive 2.5 or 2.45 for the year. Long-dated treasuries really had a big run, 2% there, now back to positive for the year. Durable goods orders dropped at an annualized pace of 6.3%, but that's on the back of a real big month up the month before. You see that pattern a lot in durable goods. So you see it there, you kind of see it, well, there's down, then up right here. There it is again. So it's really nothing to worry about. It's very normal. Back out the big transportation items, which usually cause those big spikes, you actually had a 0.2% increase. So nothing to see there. Everything's fine with durable goods. One area of the economy that's just struggling, if you're in that industry, is residential housing. It's just been tough, whether it's affordability, higher interest rates, homes sitting on the market longer, price adjustments lower, becoming more and more common. In the month of March, the FHFA house price index fell 0.1%. That's just welcome news, quite frankly. It is starting to sort of absorb some of the impact of the higher rates for longer, etc. Still, though, up almost 4% on a year-over-year basis. It's not like homes have suddenly become cheap, especially here in Southern California. The S&P Case-Shiller Home Price Index for March showed the same thing, really down about 0.1%, a little better than expected, and the year-over-year there also hovering around that 4% level. Pending home sales, which we got last week for the month of April, fell 6%, 6.3%, well worse than expected, but just reversing a big gain the month before. On a year-over-year basis, though, actual down the number of pending sales, and I don't expect any relief there until such time as either prices go down more and or, in combination, interest rates go down. The affordability numbers are just not there at the current time. We then got initial claims for unemployment, and we got a little bit of a spike. You can see it here, right? 240,000 last week. You can see the red line, which is the 4-week moving average, is really moving steadily higher. And in addition to that, we've seen continuing claims continue to rise steadily higher. Now, to put this all in perspective, it's important to note anything below 300,000, it's a pretty healthy jobs market. And that when we were down in the 200, 220 range, which we were for a period of time, that's usually seen as a very tight labor market and is actually seen as causing inflationary pressure. So if you want to be a glass is half full economist, as you look at this trend, you would say, hey, it's relieving some of the inflationary pressure, but the labor market's still strong. But to be fair, when you start pushing up to 2 million on continuing claims, you have to ask questions. This is the U.S. continuing claims for unemployment graph. A year ago, 1.8. Today, 1.9. Is that a big move? Not really. We're still well below 2 million. The scale on the graph here is what it is, but it's being talked about now. It's being noticed. It's, the Fed is mentioning, hey, labor market is softening, in their minutes, that kind of thing. Does this mean the labor market is cooling? Well, to answer the question, I'd want to see more than just a rough month. You see this go above 2 million and sort of stay there, then things are getting a little tighter. This is definitely the path to that, to be sure. But I want to look at the U.S. Worker Adjustment Retraining Notices. That's one you haven't seen from me in a long time, or WARN, W-A-R-N, WARN Notices. This is actually a good graph, puts it in perspective, because this was COVID, right? The shutdown of the economy. This is the rehiring, the rehiring after COVID, very good. And so in reality, no, we have not seen a spike or a pickup in WARN notices, which makes me I don't want to say discount that 1.9 continuing. It makes me be less concerned while still keeping an eye on it. I think it's the best way to describe how I interpret that. We got the updated first quarter GDP figure. Originally it had come in at minus 0.3. It was revised to minus 0.2. Personal consumption was revised lower. That's interesting. That's a little bit disinflationary. But the real culprit here is net exports, right? It was because imports surged ahead of the tariffs. So we really don't see that final goods, consumption was great. It was strong. It was fine. We didn't have a negative GDP. This is not a recession. The other thing I think is actually a bit of a positive. And in the first quarter, government consumption, expenditures, and gross investment. In other words, government spending. It wasn't down big, but it's a miracle when it doesn't go up. And to see it go down even a little bit as GDP grows, right, and as you have inflation, etc., that's a bit of a positive development, because debt and deficit are really the biggest problems we have. It's definitely not an all clear sign. It's literally just a quarter, and it's just down 0.1%. But it was welcome to see in the GDP figures. We also got personal income and spending for the month of April. These are really good indications of how the consumer is doing. And the consumer, of course, is a derivative of the jobs market. Personal income up 0.8%. That was above expectations. Personal spending up 0.2%, right in line with expectations. I mean, savings are good. Solid report. Nothing to worry about. Everything looks good there. We move on to PCE inflation. This is the most important inflation gauge. The reason it's the most important is it's the one the Fed uses to determine policy and short-term interest rates. Their self-imposed objective, Congress gave them the objective of price stability. Price stability. Price is the dollar that should maintain its value, essentially. And when you have inflation, you don't have price stability. When you have deflation, you don't have price stability. When Ben Bernanke left the Federal Reserve, one of the things he did right before he left is he gave us a target to define price stability. So it hasn't been that long. What was that, 15 years or so? He defined it as 2% core PCE inflation. This is similar to what the Europeans do in other countries where they don't really call it. Zero is not their target, right? That would be true price stability, just a small amount of inflation. So 2%. We are still above that. The core, as you can see, is above the headline, but the headline tends to drag the core. As you can see here, it tends to lead. And so the PCE price index is right there, 2.1. If it could go below 2 in the next couple of months on a year-over-year basis, that would be big, because it would likely bring down, continue to drag lower the core, slower moving. It's just currently at 2.5. Get that down to 2, and then the Fed can say we've met our inflation mandate. Then the Fed certainly could feel like they could lower rates to bolster the relatively soft labor market, if it indeed is soft. We just went through a number of slides suggesting it's not all that soft at all. Okay, move on. We got Chicago PMI, Purchasing Managers Index for the Chicago region. Above 50 is growth, below 50 is contraction. It's been in contraction here for about 3 years. So nothing to see there. It remains there. It was well below the expectation of 45, and it came in at 40.5. Conference Board consumer confidence rose from 85.7 to 98. That was welcome. But 98, you see it over here, it's still kind of low. people aren't feeling great. We were, here we go, 120 back before, in 2018, 2019. We have a long way to go to get back to that. Current conditions rose, expectations rose. So it's positive. Yeah, directionality is good, but on an absolute level, it's still not all that great. In addition to conference boards, consumer confidence reading, we've got University of Michigan's consumer sentiment, which remains really low. Consumer sentiment was unchanged, 52.2 month over month. Current conditions fell there. Expectations, though, picked up a tad, but these numbers are really, really low. You have to go back to COVID. You're actually way below even the COVID shutdown numbers here. Most of that has to do with inflation and concerns there around tariffs, etc. Importantly, last week, the Fed released the minutes from its last meeting of the FOMC. They correctly cited what I just cited to you, which is that core PCE is still above 2% at 2.5%. Then the labor market is still pretty strong, right? Okay. So because of that, they're willing to wait on cutting interest rates. I know the president would like them to cut interest rates. The Treasury certainly would, because it dictates the borrowing costs of the federal government. But I think it's the right move. Inflation is still above target. They need to be very careful. They believe the risks, though, to both employment and inflation have increased since the prior meeting. So they say, well, we're actually seeing underlying indicators that suggest that unemployment might go up, which I just showed you, the 1.9, and that inflation might go up. And that was kind of not a total surprise to the market, but seeing them say, hey, we're still very concerned about inflationary risks in the economy. That's a nod towards, obviously, the tariff situation. They did forecast that the labor market would continue to weaken, causing unemployment to rise, and they forecast higher inflation related to tariffs. So it's time to break out from the 70s and the 80s, our old misery index. This was probably the most important economic indicator we used back then. You simply add the inflation rate to the unemployment rate, and that is misery, right? This is stagflation. So the question is it high? And the answer is no. Look, it's pretty much at an all-time low. If we started to tick higher here, we'd want to look at it. I'm going to probably look at it more frequently now that this is a concern because the Fed put it in their minutes. But I think they're just being political, smart, and cautious. Okay, plenty of data this week. We got S&P Global's May PMI. This is the final readings. We're in June. We've got ISM's manufacturing PMI. You can see there, one is expected to show growth, one is expected to go very slight contraction. Construction spending, factory orders, JOLTS or job openings. This will be big to determine directionality on that labor market. Auto sales, 16.3. Then we've got the jobs reports, right? We've got the ADP employment report estimating 110. We've got the two services PMIs, both showing expansion in the economy. There's a Fed meeting on June 18th. The Beige Book, which is their board book that they get, will come out this week on Wednesday. Weekly claims on Thursday, trade deficit. Then productivity and labor costs. Friday, the BLS, Bureau of Labor Statistics jobs report, suggesting we added 130,000 jobs and unemployment remains at 4.2%. That's great. Consumer credit and average hourly earnings all rounding out the week. Okay, don't forget, you can find the audio pretty much anywhere. The video is YouTube only. The YouTube channel is Slaying Bulls and Bears. Make the complex and complicated simple and sensical. Thanks, everybody. We'll be back to you again next week.